Hello everyone, welcome to the Home Schools. I am Mr. Sharan here. In this video, we are going to discuss about the basic concepts of accounting, or we can say the basic accounting concepts. In the previous video, we discussed about the basic terms which are used in accounts. So we discussed about what is a business, who is a proprietor, what is a capital, drawings, assets, liabilities, then what is a credit purchases, what is a cash purchases, what are the transactions. Like that, we had discussed about around 18 basic terms which we need to use in accounts. Now, in this video, we are going to discuss about the basic accounting concepts. Remember, when we are perfecting those basic terms and basic concepts, then solution for all the accounting problems becomes easy. So again, I am stressing on these topics to make sure that each and every students are perfect in basic terms and basic concepts of accounting. Now, in this video, total we have a 13 important basic concepts to understand. In the basic terms, we had around 18 basic terms. Now, in a basic concepts, we have around 13 concepts to understand. In that, the first concept to understand is business entity concept. If you remember, in a basic terms, we discussed that the business entity. So, entity is a formation. Business is or business concept says that business is a separate entity from the proprietor. So, according to business entity concept, business and the proprietor are two separate legal entities. They are not same. That is the first important thing to remember under the business entity. That is, both the business and the proprietor are two separate entities. Then the second thing is that all the transactions, transaction means what? We discussed in a basic terms. The transaction means exchange of a goods or a services with respect to the money. Now, under the business entity concept, all the transactions which are related to the business must be entered. The first thing to remember is what? Both the business and the proprietor are two separate entities. The second thing is that all the business transactions which are related to the business must be entered in the books of account. Say an example, I am running with the any business, say the cloth business. Now, I will buy a motor vehicle for my personal use, not for my business use. I will buy the motor vehicle for my personal use. So, this is the transaction. But this transaction is not related to the business. So, the transactions which are related to the personal things should not be entered in the business. All the transactions which are related to the business must be entered. That is the second point to remember. And the third point to remember is that we know that proprietor will bring the capital to a firm. Proprietor will bring a capital. What is a capital? Capital is the amount invested by a proprietor to run the business. Now, if the proprietor brings a capital to a business, liability increases to the business. Why? We already understood what is a liability. Liability means what? Obligations to pay. Here, proprietor is getting the capital to a business. Now, what business has to do? Business has to repay it to the proprietor. Business has to repay because both the business and the proprietor are two separate entities. If I start the business with the capital, I am giving the capital to a business. Means the business is increasing their liability. Means later the business has to repay it to me. In what way? Like it is repaying in the form of a profit. So, when the proprietor brings the capital, then the liability of a firm increases. At the same time, when the proprietor withdraw money from the business, Say an example, I am investing a 10 lakh rupees to a business. Now, business has a liability of a 10 lakh liability because in the future the business has to repay me. Even though I am running the business, why I am running the business? I need some income, or we can say I need some profit from it. So after 1 year, assume that the profit of my business has been 1 lakh rupees. I invested a capital of a 10 lakh and the profit is a 1 lakh. Remember, profit increases the capital. How much will be the capital now? 11 lakh rupees. Okay, if at all business wanted to pay me, it has to pay the 11 lakh. 10 lakh is a principal amount which I have invested and 1 lakh is a profit which the business has got. So total it has to pay me the 11 lakh. Now out of that 11 lakh is a liability now. Out of that 11 lakh, I am withdrawing some 3 lakh for my personal use. So what is it is called? It is called as a drawings. So this also we discussed in a basic term. Drawings means the amount withdrawn by a proprietor from the business for personal use. So in this example, I am withdrawing a 3 lakh rupees. Now what is the capital? It will become a 8 lakh. So drawings decreases a liability and investment, that is a capital, increases a liability. Okay, so these are all the points to remember under the business entity concept. That is, both the business and the proprietor are two separate entities. All the business transactions must be entered in the business point of view, not a proprietor point of view. Second thing. And the third thing is that the transactions of a proprietor which are personal will not be entered in the books of accounts until and unless it affect the cash flow of the business. What is a cash flow? If the cash is coming to the business, that is called as a cash inflow. If the cash is going out of the business, then it is called as a cash outflow. So personal transactions should not be entered until and unless it affect the cash flow. Example, I will continue the previous example. In the previous example, what I told, I will buy the motor vehicle for my personal use. If I am using the money which is not related to the business, then it should not be entered. But I am buying a motor vehicle for my personal use, but still I am buying that motor vehicle with the amount which is there in the business. What I will do in the business, assume that I got a profit of 1 lakh rupees. That profit only I will give it to the showroom and buy the motor vehicle. This we have to enter, because what I am doing, I am taking out the profit. So here the business is involved. For a business it is a cash outflow, because I am taking the cash from the business and buying a motor vehicle for my personal use. Even though I am buying it for personal use, I have to enter this because I am taking the money from the business. So until and unless the business involves, that will not be entered. If the business involves, we have to enter in the books of accounts. That's all about business entity concept. Next we have a money measurement concept. It is simple. Money measurement concept states that all the business transactions should be measured in terms of money, not in terms of physical units. That is very important. All the business transactions must be entered in terms of money, not in terms of the physical units. Take an example. I will buy, business buys a machinery. Business buys what? Machinery. Say it is purchasing two machineries. Now, one machinery cost is of 5 lakh rupees for each machinery. Okay, so into 2. What is cost it will become now? It's a 10 lakh. Now, it doesn't mean that this is original cost. So, we are paying for a transportation for 2 machineries. Say an example, we are paying a 50,000 for the transportation. From the manufacturer, 10 lakh rupees we paid them to buy the machinery. Now from that place to our place, it has to transport. For the transportation, we are paying a 50,000 rupees. Now the machinery is with our plant. Now that has to set up. Okay, now for the setting up of the machinery, we are spending a 50,000 rupees. So what is the total amount we just spent for to buy the machinery? That is 11 lakh rupees. 11 lakh rupees. Now the money measurement says that in the books of accounts, the transaction should not be entered in physical units. Physical unit in the sense, how many machinery we purchased? 2. So this should not be entered. So we have to enter in terms of the money itself. Now what is the cost of the machine? It's a 11 lakh rupees. It's not, it is a 10 lakh rupees. So 10 lakh rupees is the cost. 50,000 is for transportation. 50,000 is for installation. So until the machinery is ready to use, what all the amount we will spend, that everything we should add. Now after adding everything, what is the total cost of 2 machineries? It is a 11 lakh rupees. So in the business transaction, we need to enter purchased 2 machines for rupees 11 lakh. We should not say purchased 2 machines. We have to say purchased 2 machines for rupees 11 lakh. So this 11 lakh we have to enter in the books of accounts. That is what money measurement concept. We have one drawback in this. That is, what is the cost of the machine now? 11 lakh. Can you say that this 11 lakh will be same for all the years? Purchase cost will be same. Even after 10 years also, if you ask, I will tell that I bought it for 11 lakh rupees. But after 10 years, is the value of the machinery will be 11 lakh itself? It will be changing. Sometimes it will go 12 lakh, 13 lakh, or sometimes it will go, if the demand is not there, it will come down 8 lakh, 7 lakh, 6 lakh, like that. But purchase cost will remain the same. But market value of that machinery will keep on changing. There, when the market value is keep on changing, we are not able to enter that amount in the books of account. Because once we purchased, for how much we purchased, we have to enter for all the years. So purchased 2 machinery for 11 lakh. This year I will enter. Next year also, in the books of accounts, the price of that machinery will be 11 lakh itself. But actually in the market, the price of that machinery will be changing. So that is one drawback in the money measurement concept. That is, we cannot show actual value of the asset or actual value on that particular financial year. That is one of the main limitation of this money measurement concept. First is what? Business entity concept. So we have 3 important points to remember. That is, here both the business and the proprietor are 2 separate entities. All the transactions which are related to the business must be entered, and all the transactions we have to enter in terms of the business itself, not in terms of a proprietor. That is business entity concept. Money measurement concept. The important point to remember is that all the transaction should be entered in terms of a money, not in terms of a physical unit. One thing. And one thing is that drawback is we cannot show actual value of the asset. We can show only the purchase cost. That is a drawback of money measurement concept. Now third one, what we have? Going concern concept. Going concern. The name itself says that the business has to run for a long period of a time. That is the going concern concept is going concern. So once the business start, the business should not close within 1 year. When we are starting the business itself, we have to assume that business will run indefinite period of a time, means for a long period of a time, say 50 years, 100 years. Even we have the companies which are running for more than 100 years. At the same time, we have businesses which close down within 1 year or 2 years also. So always once the business starts, it has to assume that the business will run for indefinite period of a time. That is going concern concept. Why? Because, say an example, I bought the computer system which is worth of 50,000 to my business. 50,000. Now that is expenses. I have to recover that money which I spent, right? For how much I bought it for? 50,000. If this concept not there, assume that the going concern concept is not there, then according to that 50,000 we need to recover within 1 year. All the expenses what we will spend, that has to be recovered within 1 year, because the going concern concept is not there. It is very difficult to recover within 1 year, because if I spend 50,000 to buy the computer, what I can say, I can use that computer for 5 to 10 years and I can recover that money. I am using the computer system to run my business. It will become an asset. So I am using the asset to generate some income. I cannot generate an income within 1 year. It will take some time. So according to the going concern concept, the business has to run for an indefinite period of a time. Other way, it will run for long period of a time. That's all about the first three business concept. That is business entity concept. Here, both the business and the proprietor are two separate entities. All the transactions which are related to the business must be entered. Business point of view only we have to enter. Money measurement concept is that all the transaction should be entered in terms of money, not in the terms of physical units. And we cannot show the actual value of the money, but we have to show only the purchase cost of that money. The next we have a going concern concept. This concept is that the business will run for indefinite period of a time, or we can say it will run for a long period of a time. So next we have here accounting period concept. So accounting period, it means that we have to prepare the financial statements. What are the financial statement includes? Financial statement includes the trading account, financial statement includes profit and loss account, and financial statement includes the balance sheet. So a business has to prepare the financial statement frequently. Okay, so it doesn't mean that I will start the business now and I will prepare the financial statement after 10 years. Okay, I cannot show the profit or loss for 10 years once. I have to show the profit and loss frequently. So that is accounting period concept. It says that every business has to prepare the financial statement frequently. Now you will have a question. Frequently means what? Frequently means according to the Companies Act of 2013 and Income Tax Act, it says that every business has to prepare the accounts for every annum, that is 1 year once. For 1 year it has to prepare the accounts. Okay, so what is accounting period? 1st of April up to 31st March. This is called as a financial year. 1st of April to 31st of March, complete 12 months. So now we are in a 23 financial year, that is 1st of April of 23 to 31st March of 24. This is the one financial year we are in. Okay, so according to the Income Tax Act, it says that every business has to prepare the accounts minimum year once. Okay, but remember, we have a few type of the businesses, they will prepare the accounts on a daily basis. Say an example here, small hotel businesses. You might have seen a lot of the hotels which are located on the road street. Okay, so what they will do, they will invest the money in the morning. In the sense, they will buy the goods and they will prepare food, everything, and they will come to the market, or we can call it as a bazaar. They will sell it there, and at the end of the day, they will count how much money they got. Okay, so it on the daily basis. There are a few businesses which they are going to prepare on a quarterly basis. Quarterly basis means on 3 months once. You might have seen in the newspapers. Okay, so you will get a news that Infosys has made a 2.5 crores of a profit in a first quarter. Then Wipro has made a 250 crores of a profit in a second quarter, like that. That means those companies or those businesses, they are preparing the accounts for quarterly basis, 3 months once. First quarter means April, May and June. This 3 months is called as a first quarter. July, August, September, second quarter. October, November, December, third quarter. January, February, March, fourth quarter. So those companies are preparing the books of accounts on quarterly basis. So even we have a companies which are going to prepare the income statement or financial statement or annual basis. Okay, and it doesn't mean that we have to prepare only on daily basis or quarterly basis or annual basis. Sometimes whenever there is a change required, they will prepare the financial statement. Say an example, me and my friend both are running the one partnership firm. Me and my friend both are running a partnership firm. Now, on 1st July, there is a one other person who will admit with us as a new partner. Up to 30th June, me and my friend only two are the partners. Now from 1st July, we have a 3 partners. So at that time, immediately we have to prepare a financial statement, because once the new partner is admitted into the partnership firm, everything will change. Say an example, until new partner comes to the business, me and my friend both are sharing the profit and the losses equally. Means I will get a 50% of the share and he will get a 50% of the share. But once the new partner admit into firm, we have to give to him also. So at that time, it may be equal ratio or it may not be equal ratio. Once the new partner is admitting, assume that I am taking a 30% of the share, he is taking a 30% of the share, and we are giving a 40% of the share to the new partner. Here again, the profit sharing ratio will changes. At that time, we have to prepare the financial statement. That's all about the accounting period concept. Business entity concept. Here, both the business and the proprietor are two separate entities. All the business transaction we should enter in business point of view, not in the proprietor point of view. The personal transactions of the proprietor will not be entered. These are all the 3 points to remember under the business entity concept. Now in money measure concept, it is that all the business transaction must be entered in terms of money, not in terms of physical unit. The second thing is that the purchase cost of the machine or purchase cost will remain the same, whereas market value will keep on changing. That point to remember under the money measurement concept. Now going concern concept. So this concept said that business has to run for indefinite period of time. It means the business has to run for long period of time. That point we have to remember under the going concern concept. So here accounting period concept. Accounting period concept states that every business has to prepare the financial statement frequently. That frequency may be daily basis, monthly basis, quarterly basis or annual basis. But according to the Income Tax Act, every business has to prepare the accounts on a on a yearly basis. So here we have the cost concept. Cost concept says that here we should enter the value of the money on cost basis. So continue the same example here. For how much we purchased? 11 lakh. So this is the cost of the machine, 11 lakh. It includes original cost, transportation, setting up, everything. So this 11 lakh we have to enter. So this is the cost concept. Cost will include everything. We cannot enter that cost of the machine is at 10 lakh. We have to enter the total cost of the machine is 11 lakh, which includes original cost is at 10 lakh, transportation is a 50,000 and setting up is a 50,000. That is what? Cost concept. Okay. And last we have here dual aspect concept. Dual aspect concept means every transaction will have a two or more accounts which will affect. Dual aspect. The other way, every debit will have a equal and opposite credit. So say an example, I have a 10 lakh rupees a cash in my business. I have a 10 lakh rupees of a cash in my business. Now, out of that 10 lakh rupees, I will buy the machinery which is worth of 7 lakh. Which is worth of what? 7 lakh. Now, how much cash we have? We have a 3 lakh of a cash and we have a 7 lakh of a machinery. Okay. So, total is how much again? It is 10 lakh. Understanding? Dual aspect concept says that for each and every debit, there will be a equal and opposite credit. That is a dual aspect concept. And one more thing. So say an example that we have the already studied about accounting equation. What is accounting equation? Assets is equal to liabilities plus capital. This is the accounting equation. Other way, assets is equal to liabilities means the business which has to pay to the outsiders plus capital, the business which has to pay to the owners. Liabilities are the amount which we need to pay to the outsiders and the capital are which we need to pay to the proprietor. So assets will be always equal to total of liabilities plus capital. Now we'll continue this. So what I told, we are purchasing the machinery. We are purchasing the machinery which is worth of which is worth of what? 7 lakh rupees. Okay, so here earlier we had a cash of 10 lakh. Now we have a cash of 3 lakh and machinery of 7 lakh. Total is how much now? That will be equal to 10 lakh rupees. But only the difference is that earlier we had a total of 10 lakh cash itself. Now we have a cash of a 3 lakh and a 7 lakh of machinery. Total is how much? 10 lakh. So cash is a asset. Cash is a asset. Even machinery is also what? Asset. Okay, so total capital earlier it was a 10 lakh. Capital was in the form of only the cash. Now capital is in the form of cash as well as a machinery. Again it is what? 10 lakh rupees. So this is the dual aspect concept. For each and every debit, there is an equal and opposite credit. This statement you will understand when we start with the journal entries. So in the next video, we are going to discuss about the remaining basic concepts of accounting. After that, we are going to discuss about the classification of the accounts. So we have a different accounts and we need to classify under the 5 main heads that we are going to discuss about the next videos. In the immediate next video, we are going to discuss about the remaining 7 basic concepts of accounting. So hope you understood these 6 basic concepts of accounting. So we have a remaining 7 concepts. Okay, those we are going to discuss in the next video. Thank you, students.